lunchtime seminars, got a number of them from different perspectives, and so we'll look forward to seeing you in the future. But without further ado, why don't we jump on and talk about the webinar today. We have Dr. Ian Sheldon, who's with us. He's the Anderson's Chair in the Department of Ag, Environment, and Development Economics here at Ohio State University. He's been my colleague for a number of years. Miles, quickly, maybe take down the share on that and let Ian throw his slides up. Perfect. So Ian, we're really honored to have you here with us today. We're really looking forward to this. We know this is a topic that's you've been thinking a lot about, and I think it'll be something we can all learn a lot from today. So Ian, without further ado, why don't we turn it over to you? I'll go ahead and turn my screen off, but remind people, if you want to ask a question, you all are on mute, so any questions need to be put into the chat feature or the Q&A, but put those questions in there anytime you want, and we'll keep track of them and ask them to Ian at the end. Okay, Ian, over to you. Thanks a lot.
Thanks, Brent. Thanks, Miles, and thanks to everybody who's online today. So I have this rather grand title, How Are We Going to Feed the World? I'm not sure I completely answer that question in the presentation, but I do have some thoughts as we get towards the end of the presentation about where I, as an agricultural economist, think we need to start thinking or continue to think based on what I've been reading and thinking about as I prepared for this seminar. So sorry about that, somebody was just knocking on my door. Should have ignored that. So what motivated me, or what's been making me think about this issue, is the World Food Programme. This was writing back in July 2022. You can see that they're writing about the World Food Programme scales up to support the most vulnerable in the global food crisis. And then on the right-hand side, that's another story from the World Food Programme. War in Ukraine drives the global food crisis. So this slide is sort of my motivation for thinking about this issue, because I think as we came out of the pandemic and then with the invasion of Ukraine by Russia, the whole issue of world food prices and global food insecurity started to bubble up to the top of the policy agenda for those global institutions that write, think, worry, and try to deal with this issue. And I don't know if he's online, but my former colleague, Emeritus Professor Karl Zuloff, also wrote a couple of very interesting short pieces for FarmDoc back in November and December, respectively, about the possibility that, well, not the possibility, he makes the argument that we're seeing a gap growing between rates of consumption and global yields of food, feed grains, and oilseeds. And I'll come back to what Carl said in his two short papers later in my presentation. So let me start off by talking about where we are on global food insecurity right now. So food insecurity is defined by the FAO, that's the Food and Agricultural Organization of the United Nations, as lack of access to sufficient, safe, and nutritious food. And the next bullet shows you, this is an estimate by USDA's Economic Research Service. They put out a paper every year about the numbers of food insecure people globally. They have a sample, I think this year, of 77 countries in their sample. And they show that in 2022, the estimate of people who are globally food insecure was 1.3 billion individuals, which was up 10% from 2021. And if you look at this graphic here, this is again from the Economic Research Service of USDA. This is a graphic of the number of people in lower middle income countries who were experiencing food insecurity in 2022. The numbers, as you can see, a growth of 118.7 million people between 2021 and 2022. And I think what really comes out from this graphic is if you look at Africa, you can see that there's a pretty heavy concentration of food insecure people in the continent of Africa. Some obviously in parts of the Indian subcontinent moving over into other parts of Asia, and then some portions in Latin America. So when we think about food insecurity, if we go back to Amartya Sen, who was an economist who won the Nobel Prize, writing in his monograph on the economic analysis of famines, he made the point in that book, and development economists still think about it this way, that it's not just physical access to food that is a challenge to folks in low and middle income countries. It's often ability. They don't necessarily have the financial entitlements to actually access that food, even if that food were available. So this is an issue relating to both physical shortage of food, but also the price of food in developing countries and middle income countries where food insecurity is a key issue. So this current crisis is being driven by a number of factors. One is, if you look at the countries around the world where we observe food insecurity, many of these countries are subject to civil conflict. Think of countries in sub-Saharan Africa. Think of a country like Yemen in the Middle East. These are countries that they're either countries where the state has failed, or there's actually civil war going on, et cetera, et cetera. Secondly, we know that climate shocks are affecting levels of global food insecurity. And obviously, as we went through and came out of the COVID-19 pandemic, supply issues were also affecting global food insecurity. And what's important, and why I think the World Food Programme has really focused on this over the past 12 months, is that this crisis that was identified in 2020 going into 2021 has been intensified by the ripple effect of the Russian invasion of Ukraine. And I'll give you some sense of how that matters to a certain number of important importing countries who are very dependent on both Russia and Ukraine for supplies of wheat and corn. And then the second point is that these are obviously connected. This has resulted in rising global food prices, rising fuel prices, and rising fertilizer prices. If you're working here in the United States, obviously you've been able to observe what's happened to fertilizer prices over the past 2 years. I think what matters in a lot of developing countries is that they were pulling back from applying fertilizers because of the cost. Then that's actually going to impact their agricultural productivity and their ability to contribute to agricultural output. So here's another graphic. This is from the International Monetary Fund, but reporting on the UN's FAO data. On the right-hand side, the red line is global food insecurity. That's the millions of undernourished people. You can see that from around about the start of the financial crisis through to around about 2018, you can see that global food insecurity was actually declining in terms of millions of undernourished people, but that's actually been kicking up since just before the pandemic. That dotted line is the IMF forecasts or the UN's forecasts. The USDA forecasts would actually take those numbers above 1 billion. And then on the left-hand side, that's a real food price index. I'm going to say quite a bit about real food prices later on in the webinar, but you can see that there's been you can see the price spikes that occurred in 2006 and then 2011, and then you can see the run-up in real food prices that began just after the pandemic, going through to the invasion of Ukraine by Russia in February last year, in 2022. So let me say a little bit more about global food price increases. These prices increased very rapidly in 2021, so this actually predates the invasion of Ukraine. And this was driven by increased global demand for feed and food grains. A lot of that was being driven particularly by China, as China rebuilt its hog production capacity after the African swine fever outbreak that had occurred 2 to 3 years earlier. And partly also because the United States and China signed a trade agreement that lasted from early 2020 through to the end of 2021. So we saw big increases in corn demand by China, wheat demand, and also oilseeds demand. We also in 2021 had drought in South America. There still are concerns about drought, particularly in Argentina. My colleague, Seung-Ki Lee, who's going to be speaking in the next webinar at an Outlook meeting I was at on Friday, he was particularly focusing on what the expectations were about weather conditions down, particularly in Argentina, and potentially affecting Brazil. Third, we obviously had supply chain disruptions, even though agricultural trade was remarkably resilient during the pandemic. We still observed these supply chain disruptions. And then finally, feeding through into higher food prices and the ability to add those inputs in making decisions about agricultural production. We've had obviously considerably higher energy prices in 2021. My colleague Brent Sonjan, who introduced me earlier, he knows a lot more about the energy sector than I do, but obviously the Saudi Arabians during 2021 going into 2022 actually capped their supply to the world market, which drove up oil prices. And then even before the invasion of Ukraine by Russia, fertilizer prices were already increasing, but necessarily with the invasion and the impact on natural gas prices, that has driven up fertilizer prices, notably in the European Union, but it's also affected world fertilizer prices, not just for nitrogen fertilizers, but for other fertilizers as well. So the price increases that we observed in 2021 going through into early 2022, particularly of wheat, coarse grains, that would include, coarse grains would include corn and vegetable oils. Those price increases really intensified in 2022 following the Russian invasion of Ukraine. And in terms of thinking about food security or food insecurity, countries in North Africa, countries in the Middle East, countries in Asia, plus those countries I mentioned in sub-Saharan Africa, these are the most affected regions of the world from that invasion because they're highly dependent both on Russia and Ukraine for grain imports. So just to remind you that Russia and Ukraine between them accounted for something like 30% of globally traded wheat. And wheat obviously is one of the three most important food grains. If we think about wheat, corn, and rice, the three most important food grains in poor consumers' diets in those parts of the world. This is a graphic. These are data from a recent report, again, by the Economic Research Service of USDA. These are those major commodities that I talked about: wheat, corn, rice, and also including vegetable oils. Vegetable oils are a particularly important part of the diet of consumers in Asia. So you can see in wheat, North Africa in particular has been very heavily affected by price increases. Then if you work through to corn, again, North Africa has been very much affected by the corn price increase in 2022. Rice prices have actually, until very recently, haven't increased by as much as wheat and corn prices. But as you can see, there are several countries, regions around the world that are dependent on rice prices, and then you have vegetable oils out there to the right. This is a graphic. This is from a paper that I heard presented at the American Economic Association meetings recently in New Orleans by my colleague Jason Grant at Virginia Tech and his colleagues again at the Economic Research Service of USDA. Unfortunately, this is a big graph and the numbers are not particularly clear, but the left-hand side this is looking at wheat, and this is about the importance of wheat exports by Russia and Ukraine to a set of emerging and developing economies there on the left-hand side. So the blue bars are the import share for domestic use for wheat, and I just picked out the Lebanon. You can think the Lebanon, of course, is very close to being a failed state. They're in the Middle East. They depend on wheat imports, so 83% of their domestic use of wheat it comes from the import market. And then you can see on the right-hand side, 82% of those wheat imports are coming from or would have come from Russia and Ukraine this past year going into this year, 2023. Let me pick out another one that I think if you just look at Somalia, again, Somalia is in sub-Saharan Africa. The wheat import share for domestic use, 100% of their wheat is coming in from imports, of which 64% would have come in from Russia and Ukraine. And for many of those, you just need to look at a map of where Ukraine, the Black Sea is. Think about ships coming out of those Black Sea ports. There are 17, or there would have been 17 ports on the Black Sea open to grain exports from both Ukraine and Russia, coming out through the Bosphorus there into the Aegean, down into the Mediterranean. And then you would just turn right to go to North Africa. Lebanon there is at the end of the Mediterranean. And then, of course, you go down through the Suez Canal, you would hit Egypt, and then that would take you round into other parts of the Middle East and also Africa and sub-Saharan Africa in particular. So many of these developing countries and even some middle-income countries are highly dependent on wheat imports from Russia and Ukraine. And that's why this price increase, and where prices are also denominated in dollars, and many of these countries are highly dependent. Their debt is denominated in dollars. Those import prices are in dollars. So the rise in the dollar has also impacted their ability to import these commodities from the world market. So the story has improved a little bit over the past 3 to 4 months. In fact, today in today's Farm Doc Farm News, there's a story from the weekend's Financial Times that discusses that commodity prices have actually corrected a little bit since the invasion, have actually corrected to pre-invasion levels due to supply conditions improving. We've had increases in supplies of wheat and corn to the world market. Plus the deal that was struck originally back last August between the Turkish government, the Ukrainians, the Russians, the United Nations. This was an export deal to get grain out of 3 ports on the Black Sea, notably Odessa. And also macroeconomic factors as we head certainly with slowing global growth rates, potentially going into recession. We're seeing some impact on the demand side is affecting those prices. So this is a graphic. This is from Bloomberg. Again, this is using the UN's food price index. And you can see there out on the right-hand side, these data go back to 2013. You can see we had a big decline in commodity prices through to 2016. They sort of flattened out between 2016 and the pandemic. And then you can see world food prices shifting up to 130. I can show you a longer price series later on because I want to put these relatively short-run price changes into more of a global in a longer context. And you can see those prices really being run up to almost historic highs there. In I think May, those prices were hitting their peak. And then as we started to adapt to the invasion of Ukraine, you can see those prices falling down at the end of last year towards where they were just before the invasion. But I would like you to note that these prices, this index of prices still lies above where we were in 2013. So we're still looking at pretty high real food prices as we go into 2023. Now, having said that, these short-run price changes look to be moderating. The outlook is still pretty uncertain. So I think the short-run price risk is still on the upside. And that's being likely to be driven by these 5 things that I've listed here. One is the stability of the Ukrainian grain export deal. The initial deal was for 3 months. So that went through August, September, October, and then was up for renegotiation with the Russians in November. And in late October, the Russians said they would not re-up the deal This obviously had a very short-run impact. If you looked at the wheat price on the Chicago Board of Trade, it actually spiked pretty aggressively in late October. And the Russians were arguing that the deal did not cover their exports. In fact, the grain deal is exclusively covering exports of Ukrainian wheat, corn, oil seeds, particularly sunflower oil and sunflower seeds, because they're major suppliers of sunflower oil and sunflower seeds to the world market. The deal did not cover Russian grain exports, and in fact, Russian grain output has actually been pretty good at this last year. And even though Russian exports of those grains were not subject to the kinds of sanctions that we saw elsewhere put in place, particularly by the US and our allies in Europe and elsewhere. But I think some of this, what we've been observing is self-sanctioning by buyers, an unwillingness to buy grain from Russia. And so that deal, even though it doesn't include Russian deal, the Russians are still pushing pretty hard to see their grain exported and to see their fertilizers exported. Secondly, and this is something that I pay a lot of interest to, I've just finished a paper with my law colleague over in the law school here at OSU. We're very interested in the fact that many countries, as prices start to shoot up in 2022, they started to implement export restrictions. The objective of these export restrictions is to keep down domestic prices, although of course that then provides less of an incentive to those farmers in countries that implement these export restrictions, because the price they face domestically goes down, and they also face typically a tax or a quota on their exports to the world market. But necessarily, if countries are restricting their exports to the world market, it has a beggar thy neighbor effect on importing countries who face a higher world price. And this has been documented pretty extensively by economies at IFPRI. And I'll show you a graphic in a minute as to why I think that really matters. Third, there's a potential for continuing drought conditions and weather conditions generally around the world. I mentioned a few minutes ago concerns about drought in Argentina. We're seeing very wet weather conditions in Australia. Australia is a major producer and exporter of wheat. We had drought or very hot weather conditions in India last year that particularly affected their wheat crop. India, at least temporarily, introduced export controls on their wheat, which of course then had effect on wheat prices, at least temporarily. And we don't know how weather conditions out in the plain states are going to affect the wheat crop, the winter wheat crop in particular, out of states like Kansas. There are also very tight stocks. I'll show you a graphic in a minute to back that up on wheat. And this is a well understood idea that going back to a paper written by Angus Deaton and his colleagues in the early 1990s. Angus Deaton was another Nobel Prize winner in economics. Going back through the post-war period, what we notice is that mostly we get falling real prices of food on average, but when we do get spikes, they tend to be rather sharp, but rather limited in time. And they're typically driven by negative supply shocks in combination with tight stocks. So the tight stocks just means that there's insufficient public supplies that are available for release to the world market when you see prices rising. So I think tight stocks, particularly in wheat, are affecting the ability of markets to adapt to what's been happening over the last 18 months or so. And then finally, I've already mentioned this, that the pass-through of fertilizer prices doesn't just affect food prices here in the United States and in developed countries, but it also affects the price of food for those importing countries, but it also affects fertilizer application rates in developing countries who are food exporters. So here's just a few graphics to back up what I just said. I've already shown you that one. These are the most up-to-date data that I could find on the Ukrainian export deal. So there on the right-hand side, those are UK grain exports via the Black Sea grain corridor. That's from August the 3rd last year, when the deal came into play, through to November the 7th, taking you up to when the deal was renegotiated. So we don't have the more recent data. But what's kind of interesting, you'll see there that in fact it's mostly corn that's been exported out of those 3 ports on the Black Sea. I would note that there are 17 ports in total. It's only 3 ports. They're mostly towards the western part of the Black Sea. We don't really know how much damage has been done to those other ports, although we do know the most eastern port, which is under Russian control, was severely damaged during the invasion. But what you'll see is it's mostly corn, and that's because there was a lot of corn sitting in storage in the ports that was eventually exported. And I saw in the Financial Times story that most of this grain has not actually been going out to developing countries. A goodly chunk of it was under forward contract to developed country importers, and I think that's why you're seeing those corn numbers. If you go to the left-hand side, I think this is a story that you've probably seen pretty widely, and I think this is really the telling part of the story, that Ukraine exports last year basically are down, way down on what they were in 2021. So I think that sort of explains why there have been these really intensifying spillover effects from the Russian invasion of Ukraine. And something else you need to think about is not just that the Russians may not continue to sign up to this agreement, but that there's been a significant increase in insurance premium, not just on the ships themselves, the merchant vessels going into the Black Sea. There, the concern is the ship owners over the actual equipment and their crews. But now there are concerns over big increases in the insurance premium on the actual what's being hauled in those vessels. And those premia, which are set every January, were really pushed up very high this past January. So there's a real concern that that's going to put pressure on the number of ships actually going into the Black Sea. So sort of watch this space is what I would recommend on that. This is a really interesting graphic. This is actually data put together by folks at IFPRI and the FAO. And this is really getting at this issue of the beggar thy neighbor export policies and how they might affect food insecure countries. So on the left-hand side, you have the percentage of the population facing severe food insecurity. The size of the red bubbles is the population. And then on the horizontal axis, you have the percentage of food imports impacted by other countries' export restrictions. And I think the bubble that you want to look at that really sort of highlights this is Yemen and Afghanistan. There, 30% of their food imports were being or have been affected by food export restrictions by other exporting countries. And you can see that about 55 to 60% of their populations are facing severe food insecurity. And both Afghanistan and Yemen are obviously countries that are subject to significant civil conflict, which goes back to the comment I made earlier about how it's not just what's been happening in Ukraine that's affecting food insecurity, but it's also the existence of important civil, there's been a civil war in Yemen for a number of years. And obviously we know what's been happening in Afghanistan, but not just since the withdrawal of US and the United Nations troops from Afghanistan, but even before then. Finally, here, this is a graphic to show you, just to back up what I was saying about tight wheat stocks. You can see that wheat stocks were growing up to around about mid-2020, late 2020, and then we've seen a significant decline in those stocks moving into 2022. And something that I find quite interesting about these wheat stocks is that globally, 50% of global wheat stocks are actually held by the Chinese. And the Chinese wheat stocks, which are mostly held by public stock holding institutions in China, including their really large marketing board, COFCO. These stocks are typically not, they're not going to have private arbitrageurs looking at world prices and choosing to export those stocks back out onto the world market. Those stocks are being held by the Chinese because the Chinese are actually the largest wheat consumers in the world, and they typically hold those stocks for their own domestic use. So, that I think that decline in global grain stocks, it's very important for countries outside of China that are producers of wheat to try to start rebuilding those stocks. And remember, wheat is a significant part of the diets of people who are food insecure. So now I want to switch to talking to long-run food prices, which is really my entree to thinking about where are we going to go with producing more food as we head out into the future. So it's important to understand that in the past century, from the beginning of the century, 1900, up to around 2010, that real food prices, and by real food prices, I mean nominal food prices divided by some measure of a basket of other goods. Think of those loosely as consumable products made by the manufacturing sector. Real food prices fell on average by 1% per annum over that period, while the world's population increased by 5.3 billion. Now, that did not lead to, so in other words, we did not observe the Malthusian crisis where population growth outgrows our ability to produce food. And what drove that were two things that agricultural economists well understand. And I'm probably preaching to the choir here to anybody who's studied developmental or agricultural economics when they were at college. But the first point is, to use the economist jargon, demand for food is income inelastic. Essentially what that means is that as incomes rise over time, we spend proportionately less of that income on food. So that means that think of your demand curve shifting over time. It shifts relatively slowly. Even with population growth, Engel's law still holds. Secondly, the Malthusian crisis has not been binding, at least in the period in which we examine, or has been examined by ag economists, and I'll give you some more data on that in a minute. But there's been considerable increases in agricultural productivity over the same time period. So if you can mentally envisage, and I'm not going to show you a supply and demand diagram, but if you can mentally envisage over that period of over 100 years, the demand curve is moving very slowly to the right. The supply curve is moving a lot faster. And essentially what that means is that real food prices are declining over time. And of course, that's another reason why we observe agriculture's share of a country's gross domestic product declining over time, because agriculture's terms of trade are actually diminishing. And that this goes back to what I think D. Gale Johnson called, if it wasn't D. Gale Johnson, it was another famous agricultural economist, right? Probably T.W. Schultz. Farmers around the world are essentially, this is what we call the technological treadmill, that productivity growth, technology changes over time. You have to adapt that new technology. But as you adapt that new technology, it leads to a decline in prices, which means you've got to innovate again and adapt new technology. So you're always on that treadmill. And I'm going to talk about the supply side of technology towards the end of my presentation. Now, since 2001, real food prices have actually started to increase. And we've had two major price spikes, which I showed you a few minutes ago, since the price spike that we're currently observing. And this has led to renewed concerns about the pace of agricultural productivity growth. And this, we were alerted to this by Keith Fuglie and one of his colleagues at the Economic Research Service back in 2012. Keith Fuglie is probably one of the ag economists who writes the most about agricultural productivity growth, and he's just been made a fellow of the Agricultural and Applied Economics Association this coming summer. So here's the context of long-run food prices. So these are data that I got from the FAO. Their index currently, they take it back to 1961. The blue line is nominal food prices, and the red line is real food prices, and it's real food prices that we typically concentrate on. So since 1961, you can see that we had that major spike in food prices. That would have been, of course, the oil price crisis back in the mid 1970s, and of course we were running really high rates of inflation during that period. And then you can see a significant decline in real food prices up to the mid 1990s. A lot of that was the discussion that I just suggested, although some of that was driven by the farm policies of developed countries, particularly the European Union, that was using export subsidies to dump its surpluses on the world market during the 1980s, which drove down nominal and real food prices pretty significantly. And then we had the Uruguay round agreement on agriculture in the mid 1990s, which sort of put a stop to those distorting farm policies, particularly by the European Union, and you see a little bit of stabilization of real food prices there. They continued through the 2001, and then you can see this spike in 2006 going through to the spike in 2011, and then you can see that food price spike in 2021 going into 2022, and you can see that in at least in the data period that I've shown you that's a historic high relative to the oil price crisis, which is why so many agricultural economists are worried about this real food price increase, which we then connect back to the potential for higher rates of food insecurity around the world, and why trade economists like me worry about export policies intensifying that food price spike, and also the spillover effect from the invasion of Ukraine. So let's now talk about why ag economists are worrying about this. And, going back to this comment I made based upon the observations by Keith Foodley and his colleagues at the Economic Research Service of USDA. So the FAO in 2012, and I think these data are still pretty valid, demand for food is forecast to rise by another 60% around the world by 2050. But Karl Zuloff, in his paper that I mentioned that he wrote for the Farm Doc organization at the University of Illinois, this was the paper he wrote in November of last year, he observed that there's an increasing gap between consumption growth and the rate of yield growth for both feed and food grains and oil seeds. And you can see here, this is a graph directly taken from his Farm Doc paper from last November. So the flat, the solid blue line, that linear line, that's trend yield growth, and then the dotted blue line is the needed yield increase to meet that consumption growth rate. And you can see around about 1988, 1999, that needed yield increase is now growing faster than trend yield growth. And in a follow-up paper, because I think he had some slightly newer data that he was using in his December paper, and that December paper was actually more about, was as much about China as it was about global issues, that he notes that he argues that 16 million acres per year are required to satisfy that consumption growth that he talked about in his previous paper. And he makes the point that at least 50% of that annual increase in acres would have to come, would have to be there to meet Chinese consumption rates. So I think that's a really interesting statistic. And I think he argued that additional land coming in production was you could approximate that by 2 or 3 states out there in the Corn Belt, including Illinois. Now, I think other, this increased supply, the other ag economists have been arguing that probably this has to come at what we call the intensive margin. So this is either going to have to come through increased yields, or it's going to have to come through increased cropping intensity on a given amount of land, as opposed to the extensive margin. Although I think Seung-Ki Lee in his talk in the next webinar will probably talk about the extent to which we're seeing increased yields down in Brazil, as opposed to increased growth at the extensive margin, how much land is being brought particularly into corn production. I mean, my sense is from what he said last week is that it's double cropping of corn is leading to that additional corn coming onto the. He noted that Brazil is now catching up with the United States in terms of corn exports to the world market. But I'll leave that to Seung-Ki to talk to you more in detail about that. So if we don't have increased land conversion and we observe stable yield growth that I just showed you in that slide, then what's, as Carl points out, and then any good agricultural economist would point out, that if you don't get more land coming into production, if you don't get increased yields, then you're simply going to see a continuation of that increase in nominal and real food prices just to ration supply. And Carl makes that point very forcefully in his November 2022 piece that I mentioned a few minutes ago. So let me talk now about output growth and productivity. So ERSs, and this again is relying on data from Keith Fugly at the Economic Research Service, output growth globally is now at its lowest level in the last decade since the 1960s. So I think you can see this pretty clearly. If you go to the left-hand axis is average annual output growth, and then what are the contributors to that output growth? And you can see that that blue line was increasing, that's output growth in agriculture in percentage terms from the 1980s through to the 2000s. And then you can see quite a substantial decline, and this is in global output growth rates. And then if you look at the bars themselves, the light gray blue, that's improvements in total factor productivity. So you can think of that as the contributions of technological change. The light yellow is more inputs per acre. So that's in intensification of production on a particular area of land. The browner mustardy color is extension of irrigation to cropland, and then the red part of the bar is the expansion of agricultural land. And you can see that the major contribution to output growth in the 1990s and the 2000s was improvements in agricultural productivity, but you'll see the biggest weight on the decline in agricultural output growth in the last decade has been a decline in the contribution of technological change and total factor productivity. So that's what that second bullet says, that the total factor productivity growth has also declined over the same period. And total factor productivity is the overall efficiency with which all agricultural inputs are combined. So in the 60s and 70s, it was input intensification and research and development, think the Green Revolution, that drove output growth, after which total factor productivity growth accelerated. But since it's really slowing total factor productivity growth that has been the key factor weighing on output growth in the 2010s. So the slowdown in productivity growth means that farmers are either going to need to use more land and or apply inputs more intensively if we don't see a return to those rates of productivity growth that we saw in the 80s, 90s, and the 2000s. Where's the slowdown been? Well, it turns out that output growth has actually accelerated in the developed countries over the past 2 decades, and total factor productivity growth has been the largest component, whereas we see the opposite in developing countries. So this is the same graphic that I just showed you, or the same kinds of data for output and productivity For developed countries, you can see actually declining output growth in the developed countries through the 1990s. Then that's the blue line, and then an increase. And you'll see that most of that has been driven by increased total factor productivity. If we look at the developing countries, you can see that output growth grew from the 70s through to the 90s. And then we've seen declining output growth and a pretty sharp decline actually between the 2000s and the last decade. And again, a big chunk of that output growth has been driven by factor productivity. But you'll notice compared to in the developed countries, you'll see land either being taken out of production or it's not adding to agricultural production growth. Whereas there has been an expansion of agricultural land in the developing countries. Of course, this varies across developing countries. That total factor productivity growth was fastest in Brazil, China, Mexico, and Ukraine. But we've observed negative TFP growth in countries like Africa. And TFP growth has been due to expansion into less productive land. Sorry, negative TFP growth has been due to expansion into less productive land, degradation of natural resources, and climate change. So why the slowdown? I'll just briefly finish up here. Several factors are linked to this slowdown in total factor productivity growth. Weather shocks associated with climate change, emergence of new resistant crop diseases and pests, which means existing technology sort of becomes obsolescent, plus you would just necessarily see declines in agricultural output growth, slow diffusion of technologies, especially to developing countries, less innovation and insufficient investment in agricultural R&D, and trade and other barriers limiting technology transfer. And so, Brent, I'm just going to finish on this slide. I had a couple more slides, but I see them coming up against my time limits. And the final slides are a bit sort of nerdy. I actually have a production function, so I won't beat our participants up with that because I think I can make the main point here. So again, utilizing, this is a great graphic from a very recent report by the Economic Research Service, which I thought does a really nice job of explaining where real output growth comes from. So total real output growth is made up of that total factor productivity growth. So you can think of that as the impact of technological change and other institutional factors on output growth. And I've circled the one that I think is the most important, research and development. You can add in extension and education institutions, market access, and other institutional reforms. But Keith Fugly and others like Julian Alston and Phil Pardee, who are the other two ag economists who write extensively on agricultural productivity and the connection to research and development investment, those are the key policy drivers. And the point I want to make here, Brent, is that at least up to 2010, about 75% of investment in research and development, both in the developed and the developing world, was by public institutions, be they government or international public institutions like the CGIAR. These are the groups around the world that invest money in research, particularly in wheat and rice. And this research and development accounts for most of that growth in total factor productivity. There are over 100 studies that show that investment in research and development is what's really driven that total factor productivity growth. And the concern amongst ag economists is that with a slowdown in that R&D, and given that the stock of R&D as depreciates over time, that we need to maintain that R&D just to keep the stock of R&D constant, but we need to increase that rate of R&D growth given expansion in consumption and the fact that it doesn't appear that we're adding land at the extensive margin. So I guess my basic point is that probably the key policy point that I want to make is, and this is not meant to be self-serving as a professor of agricultural economics in a college of agricultural economics that has an extension, an experiment station up at Worcester. I think this is a broader point that agricultural economists who work in this area are making is that it doesn't look like we're getting that yield growth right now. And this is just raising the question, where are we going to get that yield growth? And where are we going to close that gap between yield growth and growth in consumption? So and on that, and the other policies down below, Brent, and others that lead to input intensification and land expansion, many of these, of course, are not very positive policies. So, for example, those trade policies that have a negative effect on domestic prices because you're stopping those countries exporting, that leads to farmers putting on less inputs because they're not getting the price they want to get domestically, and they're going to get taxed to export. And a lot of trade policies prevent access of commodities to importing countries, and so that stops these spillover effects that are very, very common with agricultural R&D, agricultural innovations, and the diffusion of those innovations. So, Brent, I'm going to stop there. I apologize, I did talk longer than I intended to, and I see there's a number of questions in chat in the Q&A. So I'd be happy to answer any questions that we got.
Yeah, great. That was super interesting. It raises lots of questions in my mind. I'd like to follow up on some of those. But first, I wanted to, I guess, an interesting question from Gretel Lynch in the Q&A really had to do with the wheat market. And it was spurred by one of your earlier slides. And, I mean, the point that Greta's raising, or question Greta's raising, is, how much do we rely on imports of wheat? And isn't the issue that consumers should be thinking about less how much are we physically importing or exporting, but how tied together these markets are? Because it really doesn't matter if we're importers or exporters of wheat, does it? If wheat markets are in short supply somewhere in the world, we face a higher price for wheat no matter what. Is that pretty much true in agriculture in general?
Yeah, I mean, I think what the two recent price spikes and the current price spikes are showing us is that we have much more globally integrated markets than we did back in the 1970s, 80s, and even the early 1990s. And a lot of that's been driven by, we have had extensive trade liberalization. There's been significant cuts in tariffs, even though we still have quite distorted international trade in agriculture. And, a lot of the advice, particularly to importing countries in the developing world, was to rely on international trade as a means to insure yourself against price spikes, domestic price spikes. And that's all very well as long as you have, you have continuing declines in real food prices over time, and you don't have these significant supply shocks to the market at the same time as you have low stocks. I mean, if you go back to 2006, we had a number of things that caused that price spike, including the shift towards biofuels, which sucked a lot of corn out of the world market, and to some extent some oil seeds. And if you looked at the rice market in 2006, we had over 160% increase in rice prices, right? And that was driven by the world market's actually quite thinly traded. So that means there's not a lot of rice being traded on the world market. But some of the major producers, and this was China, Thailand, India, Vietnam, all slapped export taxes onto their exports of rice, which of that 160% increase in the price of rice, 40% was just because of export policies. So so you've got the World Bank, people like me, the FAO, the WTO, telling developing countries that are importers, use the world market as your storage or your inventory, and then the exporters come in and distort world markets. So I think what I'm trying to get at here is that we don't need these distortions in international trade to add to the price spike, which is a function of the supply shock, weather conditions, and the fact we have low stocks right now. I mean, I think it's important, we have to revisit, and quite a lot of my colleagues who study these things are saying, we need to go back to think about public stock holding and inventory holding, as well as just relying on the world market. But we do need to stop countries using these beggar thy neighbor policies. And one of the problems is the reason so many developing countries, even if their exporters use these policies, is they don't have any functioning food security safety nets. And trade policies are easy to implement, and it generates government revenue, and it leads to popular politicians who might be very unpopular for letting food prices rise, sort of get off the hook at elections. I mean, we know the Indian Prime Minister got re-elected in 2009. His platform was, I kept down food prices. Although interestingly, India did not release its public wheat stocks to the market at that time.
Yeah, so, well, I mean, I think the short-term things are super interesting. I guess I was struck by then also the longer-term comment that Thomas O'Donnell brought up, and this is, me, I'm a climate change economist. So I really think about these climate change issues. You're worried about, and one of the long-run issues you point out is research and development. Are we going to get the yield gains over the long run to really keep keep it from having to use a lot more land for food, or from seeing higher and higher prices? But as Thomas O'Donnell points out, there is a trend of people pushing towards more vegan diets, towards reducing the amount of meat that we consume, and the things specifically of red meat, not so much pork and chicken, but in particular beef. So there are a lot of people who are suggesting that we need to move that direction, and there's policy efforts pushing us in that direction. So there's also sort of the demographic transition slowing. I mean, China's population actually fell recently, right, in the last year. So are these things going to help us in the long run? Are they going to be strong enough to offset some of the limitations we're having in research and development?
Yeah, I think that on the population numbers, I mean, I saw those numbers, Chinese birth rates are declining, and, there is a concern that's going to lead, have an impact on Chinese economic development. I think it's just going to speed up the rate at which China moves towards being a middle income economy, and, switch to, it will be less driven by export-led growth, more by, import-driven behavior. But on the climate change side, I mean, I think one of the, I made this point on this last bullet, that I do think total R&D investment has to grow faster than the desired rate of output growth. But I think there's this issue on the limits of transfer of technology across agro-technology. In other words, we can develop, new varieties of corn or wheat or whatever for, say, North America, which may be a moderately more drought resistant, say, for Canadian wheat than they have been. But are they is that technology necessarily transferable to the Indian subcontinent, for example? And I do think, there was a paper that I can't go into the details, but by some guys in the Journal of Political Economy, where they looked at how will agriculture adapt to climate change, and how will that change countries' comparative advantage if you have changes in agroecological zones because of climate change. And they make the point that, in fact, most of the adaptations are going to occur through domestic production. So countries will try to adapt themselves, as opposed to trade, which, as a trade economist, I didn't believe those results. And there are more recent papers that suggest these guys were economists. They weren't ag economists. They didn't understand agricultural demand. They didn't really understand agricultural production. And these are French guys, and lo and behold, they came up with a result that said most of the adaptations are going to occur through trade, not through domestic production adaptation. So I think we're still at an early stage trying to forecast how climate change, adaptation to climate change, maybe R&D and innovation is going to allow us to deal with that. But this is me just sort of looking through at my crystal ball. I don't think we can avoid R&D one way or the other to adapting to those yield issues, be they continuing to feed more cows to meet demand for meat in China, or put the hogs to meet demand for pork in China, or adapting to produce grains that would be more suitable for a vegan diet. I think it still posits the question that we need probably more public R&D and even more private R&D for that matter.
Yeah, no, that definitely comes through pretty clear from, I think, all of the numbers you presented. I just want to let everybody know we're just a little bit past the 1 hour. We're going to go ahead and ask one or two more questions. Feel free, obviously, to go ahead and leave, but I do want to point out that Miles put in the chat a link to our next webinar, Dr. Sinki Lee, who will be giving this webinar next month at the beginning of February. Please have a look or go to that link if you'd like to register for that webinar. We definitely invite you to attend. And we'll, of course, also be sending emails out to folks to let them know about that webinar and our future ones. So Alan Lyons, of course, asked a question about Engel's law and, wants to sort of understand better how Engel's law interacts with increased dollars spent on food and rising disposable income. Engel's law to most of us is a bit of a mystery, but, maybe you can help us understand it a little better, Ian. What is Engel's law and why does it matter? I guess that's really kind of what Alan's question is.
Well, first of all, just so there's no misunderstanding, it's not Engels, who was the co-author of the Communist Manifesto with Karl Marx. It's actually Engel apostrophe S, who was a German statistician. And Engel's law, basically, if you can think of, you have a pot of income, and when you're on relatively low income, you have low purchasing power. The proportion of your income spent on food is going to be very large. So you can think of somebody living in a small village in Africa, probably spending, Brent, I'm not a development economist, but hazarding a guess, 80% of their disposable income probably gets spent on food and the rest gets spent on shelter and clothing would be my guess. But as your income rises over time, obviously in a country like China, they've gone, there's been a significant increase in income, but their income per capita in China is still at about $13,000 per annum at purchasing power parity. We've seen a big increase in their meat consumption, so they're obviously switching from a subsistence diet to a very heavy protein-based diet as their income increases. But over time, as income in China pushes towards, American incomes, we're averaging what, $65,000 per capita in purchasing power parity. The proportion of our income that we spend on food declines. So it's not that we don't buy less food; it's a proportion of our income. Now we might see a revenue effect, and I always tell my students, we switch from eating rice and beans to caviar and champagne. So that's, as we get richer, we maybe substitute towards higher quality foods. We maybe eat out more in restaurants. But even as a proportion of our income, there's no way I spend more than about 10% of my average monthly income on food. In other words, we come up against physical constraints. You can only eat so much once you have enough income. So you can look at it over time. We see declining proportions of income spent on food across, the income distribution. We see Engel's law holds, and across countries at their level of development, Engel's law holds. So what that means, Alan, over a century, remember those data, we were looking at data from 1900 to 2010, which is when real food prices really started to increase. The real price of food has trended down, and it's a combination of, over time, we've got economic growth, right? Economic growth means higher incomes, higher purchasing power. Proportionately less of our income gets spent on food. That means, just think of this as a simple model where that means resources, labor in particular, leave agriculture, move into manufacturing where the price of manufacturers is higher. So that means agriculture's share of GDP declines. It also means that the demand for food is shifting very slowly over time, even as we add more people around the world. So even as we added China to the world market, demands, the supply function through technological change, productivity growth has still shifted faster until recently. In other words, yield growth has been able to keep up with growing population. And so the Malthus constraint, Malthus was writing what? His book was published in 1786. I had to actually look up the citation for my law review paper that I recently finished. Malthus was clearly a pessimist. That, in fact, Malthus, I think, is one of the reasons why economics was called the dismal science. Malthus thought that poor people would have large families, and eventually their need for food would outstrip our ability to supply food. Lester Brown was still believing that in the late 20th, early 21st century. And it's only recently that ag economists have started to worry about the Malthusian constraint, partly because of population growth, partly because of consumption growth, because of that population growth, but more because the supply function is not shifting as fast to the right as it was in the mid to late 20th century. Long answer to a short question.
Yeah, no, that's a super interesting explanation of Engel's law and what it means for here. Is that, your basic point that, the concern now is really that we seem to have had a slowdown in R&D expenditures, and it's translating into potentially a slowdown in the amount of yield growth that we're getting out of, the key grains that we use, right? And that this could create a real problem for the future. I mean, if I were to boil it down, that's the issue, right?
Yeah, and the reason we've had, I don't want to get into pointy-headed economic stuff, but very crudely, public spending on R&D matters here because this is a really good example of a public good. It's there are massive spillovers from investment in R&D, and so one of the reasons the 20th century was dominated by public funding of R&D was there was no way for private firms to appropriate the rents or the profits from investment in R&D in agriculture. And it wasn't until the biotechnological revolution, and in particular the Chakrabarty decision in the United States, that led to companies like Monsanto being able to get patents over innovations in agriculture. And so we've seen an increase in private spending in R&D because there, those firms like Syngenta, Monsanto, and all these big seed companies, they're now able to earn rents or profits on their investment in R&D and their patents. But the problem is they have relatively narrow focuses on their investment, and it hasn't replaced public spending on R&D. And the other thing I would say, and this is the work of, I mentioned Julian Alston and Phil Pardee in their work, they've shown that some of the gap in public spending has been met by Brazilian public spending on R&D, which is why I mentioned the work that what Seungki is going to talk, I think he's going to talk about next time. China's been expending a considerable amount of money on their own biotechnology, for example, but it's public spending. The problem that we do know about expenditure in developing countries is that the spillover effects are fairly minimal across borders. And so there's a real concern about. And diffusion tends to be a lot slower in developing countries because their extension and education systems are so weak. We could talk about this endlessly, Brent, but
yeah. Well, this has been super interesting, Ian. I mean, we could talk about it forever.
And I'm sorry I didn't answer all the questions. Because I know they look really interesting, some of these questions.
Yeah, well, we appreciate it, Ian. Again, for everyone who's still on there, appreciate your attendance today. We'll draw to a close now. But we do have this recorded, and we will get it on our YouTube page.
Oh, Brent, just very quickly to the early Greta's Lynch's question, I should have said this at the time. We are not a wheat importer, typically in the United States. We don't need to import wheat, but we're not a major wheat exporter either, or at least we haven't been. And so when this issue of the Ukrainian the invasion of Ukraine came up, I was asked quite often, will we be able to supply more? Well, at the time, we'd already planted the winter wheat that could have helped. But I think Canada's more of a major exporter of wheat than we are. So no, we're the United States is a major exporter of agricultural commodities, be it corn, wheat, oilseeds, and other commodities like processed poultry, processed pork, you name it. So we're a net agricultural exporter.
Right. Thanks for the clarification. Yeah, everyone, thanks for joining us. We appreciate your attendance today. We will put the recording on our website and our YouTube channel. And we'll look forward to seeing you at our next webinar in February with Sinky Lee. So thanks a lot, Ian. Got the recording off there.